Assalamualaikum, and now we will start uh, the MCQ session, right? And we will look at the first question. IS 16 property plan and equipment requires an asset to be measured at cost of on its original recognition in the financial statements. EAW used its own staff assigned by contractors when required to construct a new warehouse for its own use, clearance of the site prior to commencement of construction, professional survey fee for managing the construction work, EW own staff wages for time spent working on constitution. Well, first three all need to be capitalized. A proportion of EW admin cost based on staff time will be expense. Okay. The collection allocation of EW's admin cost would not be included in this cost, are not directly incurred as a result of carrying out the construction. All of the others are costs which would not have been incurred without the related asset being built. Number two question. Now, let me. Okay, on what's firstly, what is the total charge to the statement of profit or loss in respect of the decommissioning for the year ended 30th June 2005? On 1st July 2004, experimenter opened a chemical reprocessing plant. The plant was due to be active for 5 years until 30th June 2009 when it would be decommissioned. At 1st July 2004, the cost of decommissioning the plant were estimated to be 4 million in 5 years' time. The experimenter considers that the discount rate of 12% is appropriate for the calculation of a present value, and the discount rate at 12% for 5 years is 0.567. Okay, so the cost of decommissioning is assumed to be an obligation for the entity. The amount should be included in the cost of the asset when it is first recognized 1st July 2004. Okay, so the amount to include in the cost of asset for decommissioning asset is present value of the future expected decommissioning cost. So present value will be calculated by multiplying the expected future cost by a discount factor, which in this case will be 4 million into 0.567, the 12% rate, discount rate. Okay, so that will be 2.268 million. Now what we will do, cost of asset debit 2.268 million, and provision for decommissioning costs will be credit 2.268 million. The asset is depreciated on a straight line basis over 5 years time. And in addition, the decommissioning cost should be increased to 4 million by the end of year 5. This is done by charging a finance cost each year. This is charged at the cost of capital of 12% and applied to the balance on the provision account. The finance charge for the year to 30th June is 2.268 million into 12%. We will get 272,160. So that will be finance cost debit 272,160, and provision for decommissioning cost is 272,160 credit. So far so good. Now the depreciation, two costs need to be expensed, and what are those? Let us see. First, depreciation 2.268 million divided by 5 years life, that will be 453,600, and our finance cost, which is 272,160. Total is 725,760. So B will be our answer, which will be expense. Now, next towards the next question, folks. An entity purchase. First we will look at the requirement. What is the gain on disposal of the property that would be reported in the statement of profit or loss for the year ended 30th June Act 7? So that means yes, start is from 1st July, X6, by the way. Now we will what it's saying, an entity purchased property for 6 million on 1st July 2003. The land and area purchase was 1 million. The expected life of the building was 50 years and its residual value is nil. On 30th June X5, the property was revalued to 7 million, of which the land element was 1.24 million and the buildings 5.76 million. On 30th June 2007, the property was sold for 6.8 million. Okay, so what we will do, three headings: land, building, and total. Okay. So cost at 1st July X3 firstly will be 1 million of land, 5 million of building, total is 6 million. Now building depreciation, per building depreciation 5 million out of 50 years life. So we got zero point 0.1 million and we will recognize the depreciation for 2 years till June X5, 2 years. So zero point 0.2 million, zero point 0.2 million. Carrying amount 30th June X5 1 million, 4.80, 5.80. Revaluation gain is 0.24 million. We will get 1.96 and 1.20. So revalued amount over here will be 1.24, 5.76 and 7. Now building depreciation 5.76 divided by 48 years is equal to 0.12 per year. Into 2 years we will get 0.24 depreciation from X5 to X7 deducted. So carrying amount 30th June X7 1.24, 5.52 and we'll get 6.76. Disposal proceed 6.80. Gain on disposal 0.04. That's it. So the gain on disposal is 40,000. 1 point million balance on the revaluation reserve is transferred from the revaluation to another reserve account, probably retained earnings, but is not reported through the statement of profit or loss for the year. So 40,000 is the answer. So now next question. Okay, now I need to clear this. I need a space, so I'm rubbing it. Okay, what is the deferred income liability balance at 30th June X3? The manufacturing entity receives a grant of 1 million towards the purchase of a machine on 1st January X3. The grant will be repayable if the entity sells the asset within 4 years, which it does not intend to do. The asset has a useful life of 5 years. What is the deferred income liability balance at 30th June X3? Okay, the grant should be released over the useful life, not based on the possibility of the item being repaid. Therefore, the 1 million should be released over 5 years, being a release of 200,000 at 30th June X1. 6 months should be released. Meaning 1,000 will be released. Okay. The grant. What's the grant? 1 million, right? So, and grant is for useful life of asset of for 5 years. So five, we will get 200,000. Now, for half a year, from 1st January to X6, the grant we can realize is 100,000. So 1 million minus 100,000, we will get 900,000 deferred income liability. Next question. On 1st January 2001, STI received 1 million from the local government on the condition that they employ at least 100 staff each year for the next 4 years due to an economic downturn and reduced consumer demand. On 1st January X2, STI no longer needed to employ any more staff and the condition of the grant required full repayment. What should be recorded in the financial statement on 1st January 2000 X2? So reduce deferred income balance by 750,000. No. Reduce deferred income by 750,000 and recognize a loss of 250,000. This is relevant grant, revenue grant, and therefore be released to the statement of profit loss over the 4 year life. By the end of year one, the 250,000 would have been credited to the statement of profit loss, leaving 750,000 held in deferred income. At this point, the amount is repaid, meaning that deferred income is removed as well as the 250,000 income previously recorded. If you selected A, you have not removed the income that was released in the prior year. If you selected C, you have missed that 250,000 would have been released in the previous year. If you have chosen T, you have made errors over the deferring of the grant and that revenue that the repayment would be treated as an expense. Next, which of the following properties owned by Scoop company would be classified as an investment property? Um, A property that had been leased on a tenant but which is no longer required and is now being held for sale? No. A land purchase for its investment potential planning permission has not been obtained for building construction of any kind. So B is the answer over here. As you know, asset A would be classified as a non-current asset held for sale under IFRS uh, 5 non-current assets held for sale and discontinued operations. Asset C and D would be classified as property plan and equipment under IAS 16. Now, next question. Next question. During the current year, an entity had in place 1 million of 6% loan finance and 2 million of 9% loan finance. It constructed a new factory which cost 600,000 and this was funding out of the existing loan finance. The factory took 8 months to complete. To the nearest thousand, what borrowing cost should be capitalized? Very simple. Weighted average cost of borrowing 1 million into 6% plus 2 million into 9% divided by 3 million. Therefore, amount to be capitalized 600,000 into 8% into 8 divided by 12, we will get 32,000. Okay, so 32,000. Therefore, our answer is 32,000. Which of the following statement is correct? The revaluation model is used for property plant and equipment. Revaluation must be subsequently be made with sufficient regularity to ensure that the carrying amount does not differ materially from the fair value at each reporting date. This statement is true when an item statement when an item of property, plant, and equipment is revalued. There is no requirement that the entire class of assets to which the item belongs must be revalued. That the statement is false. IAS 16 states that when the revaluation model is used, revaluation should be made with sufficient regularity to ensure that the carrying value of the assets remain close to fair value. IAS 16 also states, para 36, that if one item in a class of assets is revalued, all the assets in that class must be revalued. Next question, which two of the following items should be capitalized within the carrying amount of an item of plant? So cost of transporting the plant to the factory, yes, right one. And cost of installing a new power supply required to operate the plant, yes, correct one. So the maintenance and training cost should be expensed as incurred. The residual value should be taken into account for the purpose of calculating depreciation, but not for the amount to be capitalized. Okay. Next question. At what amount will be the office building being known in the Tibet statement of financial position? Tibet acquired a new office building on 1st October. Export its initial carrying amount capitalized of land 2,000, building structure 10,000, air conditioning system 4,000. The estimated lives of the building structure and air conditioning system are 25 years and 10 years respectively. When the air conditioning system is due for replacement, it is estimated that the old system will be dismantled and sold for 500,000. Depreciation is time apportioned where appropriate. What amount will be the office building be shown in Tibet's statement of financial position at 31st March X5? Okay. So land not depreciated. Remember that. Okay. Building structure. It's simply 10,000 divided by 25 years life into 6 divided by 12. We will get 9,800. Air conditioning system 4,000 minus 3,500 because old system is dismantled or sold for 500,000 divided by 10 years life into 6 divided by 12, we will get how much? 3825. Total cost 15,625. So yes, A will be our answer. Next question. The following trial balance extracts to property which is owned by Wheaton as at April. X for property at cost 20 years original life. Accumulated depreciation at 1st April 2000 X for 3,600 on 1st October X for the following a sustained increase in property prices. Wheaton reevaluates its property to 10.8 million. What will the depreciation charge in Wheaton statement of profit or loss for the year? So 11. 6 months after depreciation to one of the revaluation will be 300,000. So 12,000 divided by 20 years into 6 divided by 12. 6 month depreciation from the date of revaluation to 31st March X5 would be uh, 300,000 in this case. And after the revaluation, now the value is 10,800 divided by life remaining is 13.5 years into 6 divided by 12. Total depreciation is 700,000. Oh, sorry, in this 400,000 and total depreciation is 700,000. So 700,000 is the answer. Which two of the following statements about IS 20 government grant and disclosure of government assistance are true? So government grant related to the purchase of an asset must be deducted from the carrying amount of the asset in statement of financial position. Wrong. A government grant related to the purchase of an asset should be recognized in profit or loss over the life of the asset, right? The free marketing advice provided by the government department is excluded from the definition of government grants. That's also right. Okay, so item A is correct as a deferred income method can be used. Item D is incorrect as any repayment is corrected in the current period, not retrospectively. Next question. Okay. What is the total net amount to be recorded in the statement of profit or loss in respect for the office for the year ended 31st December X5? Okay. Smithson purchased a new building with a 50 years life for 10 million on 1st January X3. On 30th June X5, Smithson Company moved out of the building and rented out to the third parties on a short-term lease. Smithson Company uses the fair value model for investment properties at 30th June X5. The fair value of the property was 11 million and 31st December X5 it was 11.5 million. Okay. So 10 million, 50 years life, okay, and into 6 divided by 12. What will be the expense? 100,000. So when the asset is transferred to an investment property, it should be revalue to fair value of, in case of, revalue fair value is 11 million. At that date, the asset use is changed. The gain should be recorded in other comprehensive income and revaluation surplus, not in statement of profit or loss. From this date, the fair value model is used. No depreciation is accounted for, but the value will be revalued to fair value with gains or losses going through the statement of profit or loss. As there is a gain of, so the gain was of 500,000. After that, from June X5 to December X5. This would be included in statement of profit or loss. So what we will do, overall gain was 500,000, 100,000, which are recognized earlier. So we will deduct it from here. And overall what we will get 400,000. So A will be our answer. Next question, Gilbert. Uh, what are the total borrowing costs to be capitalized in respect of the warehouse? So Gilbert took out a 7.5 million 10% loan on 1st January access to build a new warehouse building. The year construction of the warehouse began on 1st February access and was completed on 30th November access. As not all the funds were needed immediately, Gilbert invested 2 million in 4.5% bond from 1st January to 1st May. So the interest can only be capitalized during the period of construction, which is from 1st February at 6. Therefore, the interest can be capitalized for 10 months, being from 1st Feb to 1st February to 30th November access. So this gives the 7.5 million into 10% into 10 divided by 12. What we will get 625,000. Okay. And any temporary investment income earned during this period should be net of the amount capitalized. The amount earned from 1st Feb to 1st May access is uh, 2 million into 4.5% into 3 divided by 12. We will get 22,500. Therefore, the amount to be capitalized is 625,000 minus 22,500. We will get 602,500. So all interest incurred and earned in January excess is before the construction period and therefore is recorded to statement of profit or loss. Next question uh, is, if Prof company uses a fair value model for investment properties, that gain should be recorded in statement of profit or loss for the year ended 30th December X3. So what we will do, Croft acquired a building with a 40 years life of investment potential for 8 million on January X3. At 31st December X3, the fair value of the property was estimated at 9 million with cost to sell estimated at 200,000. So the fair value gain 9 million minus 8 million, 1 million should be taken to statement of profit loss, cost to sell ignored, and since Croft uses the fair value model, no depreciation will be charged on the build. So far, so good. We are done till here. We'll see you in the next session.